Well, welcome back. Time for the word on Wall Street. Top investors watching your money. Joining me right now is Michael Lee strategy founder Michael Lee and Bulltick Capital chief market strategist Kathryn Rooney Vera. Great to see you, Kathryn. Thanks very much for joining the conversation. Futures are down this morning. We are looking ahead to the November Producer Price Index out on Friday. The expectation calls for an increase of 0.2% month over month and a gain of 7.25% year over year. We also, of course, have the Federal Reserve meeting happening December 13th and 14th. Kathryn, are markets reacting or anticipating all of this? What's your take on year-end performance?
Well, momentum, Maria, is certainly to the upside. I think the Santa Claus rally is in full force, even though futures are down today. I am taking the opportunity for our clients' portfolios to adjust those portfolios and take some risk off the table. I do believe that in 2023, we're going to see a rollover in the labor market forced by the Fed. So the Fed has obviously been very late to the party in tightening monetary policy. Inflation is trending down for sure, but the labor market remains overheated. We saw this, Maria, in last Friday's non-farm payrolls number, and a labor force participation rate that is dropping. It should be increasing. So this means that unemployment remains very low, wage pressures remain intense, it's still hard to fill positions, and job openings are still very, very high. So the Fed is going to have to force the hands of the labor market, which is going to shed jobs, shed consumption, and earnings, in my view, Maria, are way too rosy for next year. So I'm taking the opportunity and advising my clients to take some chips off of the table and adjust their portfolios from one perhaps overweight equities and move more into the fixed income spectrum. The Fed's going to hike 50 basis points. We all know that next week. They're not going to surprise the markets. The terminal rate, however, is going to be above 5%. So I think that we need to start looking into fixed income, short duration for the next 3 to 6 months, and then in 2023, start going longer duration as everyone moves from talking inflation to talking the magnitude and the depth of the recession that we find ourselves in. We're not there yet, but my analysis shows that we will be in 2023 as the labor market rolls over.
Kathryn Rooney Vera, Mike Lee, great to see you both. Thank you so much. Good to see you, and we will talk soon.